Hi everyone, I'm Sid, and I'm the Senior Research Analyst at ChartMogul. Growth is the key to building any successful SaaS business. So I'm really excited to be hosting this panel on SaaS growth trends. At ChartMogul, we recently analyzed data from over 2,100 SaaS businesses. So I'm also fresh from all those insights and would love to share some of them with our panelists here and all of you. In terms of today's panel, I have a bunch of questions that I have ready to ask, but I rather ask your questions. So don't be shy and do post your questions in the moderator in the chat. So without further ado, I'll not take much time, but I'll ask our panelists to introduce themselves. Daria, do you want to go first?
Sure. I'm Daria. I'm co-founder of Salesroom. I'm based in London, originally Russian Estonian. Salesroom is a video conferencing platform for customer-facing professionals. We are AI powered and we give real-time performance on how well you're doing in the conversation. So if this was a sales call and all of you already would have switched to the other tab, I would know that, and Salesroom will tell me to be more engagement, maybe change it, maybe joke a little bit. But jokes aside, we call this life enablement, and we're the only company doing that in real time. Before starting Salesroom, I was a VC investor at a fund called Ox. And way before that, I was one of the first 5 people for Dropbox on the ground in Europe. Very excited to meet you all and hoping for a lot of engagement from the audience in the chat.
Thank you so much, Daria. Peter, probably you want to go next?
Yes, absolutely. Hi, everyone. My name is Peter. I'm the head of insights at Carta. Carta is a cap table management platform based in the US, but we help companies across the world manage their cap tables, along with learning how to compensate their employees and a number of other businesses. Right now, we have about 36,000 startups on the platform. So my role at Carta is actually fairly similar to yours at ChartMogul, Sid. I get to play around in all of our data and understand the trends and narratives that are going on within our startup community. So really happy to be here and appreciate the invite.
Thank you, Peter. Christoph, do you want to go next and introduce yourself? I'm sure a lot of our audience knows, but for the formality's sake.
Sure. Well, hi everybody. Hi Sid. Thanks for inviting me. My name is Christoph Janz. I'm a partner at Point 9 Capital. We're an early stage venture capital firm focused on SaaS. I've been investing in SaaS for about 15 years. The first company that I was lucky to invest in was Zendesk, which is also where ChartMogul's founder, maybe not started his career, but where he played a big role early on. And so I think Zendesk is close to my heart. Also, there's an important connection to ChartMogul. And over the course of those 15 years or so, I first invested as an angel investor in a couple of SaaS businesses, and then later on with Point 9, that's what I've been doing for the last 10 years or so. And I started 2 consumer internet companies in the years or almost decades before that. Those were not subscription businesses. So I think when I then slowly but surely moved over to the investing side, I also slowly but surely moved over to subscription and really appreciated the beauty of that business model, which I guess we'll talk a bit about today.
Definitely. So we have a wealth of experience here and probably 30, 40 years worth of SaaS experience in total. So I'm really excited to be discussing all the growth trends with you. To start with, probably this is a question for you, Christoph. It shouldn't come as any surprise that SaaS growth in 2023 or 2022 is the slowest it has been in years. Could you paint a picture as to what got us here and like why we are in this current scenario?
Sure. I think what's happened pretty much a year ago, or maybe a bit more than a year ago, is not that unusual for an end of a long economic cycle, right? So we've been in the world has been in an extraordinarily strong and long bull market where interest rates were low and eventually zero, or some cases even negative. So that from a macro perspective led to a lot of capital in the system, whether that's public stock markets, public stocks, pretty much any asset class, and it also trickles down to private companies, internet companies, software companies, all of that. So I think then during 2020 and 2021, I would say there was a proper bubble, right? There were a lot of exaggerated expectations and valuations that turned out to be very, very unsustainable. And then now I think we in the industry and a lot of people are going through a painful reset of expectations regarding valuations, maybe growth expectations too, which you wrote about, and I'm sure you can share a lot more details based on this amazing data set. So I think what we in the SaaS world experience right now is not really limited to SaaS, right? It's tied to a global macroeconomic downturn. Maybe in some ways SaaS companies are more affected than other companies. If you're mostly selling to venture capital funded startups, a lot of them are probably trying to reduce their burn rate. So they will look at SaaS spend, and I'm sure some of the founders in the audience, might do the same and might also experience this from a vendor perspective. But I think there are also really still reasons or aspects of SaaS as a business model or an industry that make it really strong and stronger also in tough times like this. Just starting with the fact that it's a subscription business with very high margins. So imagine you were selling some kind of product and you had a big inventory now, and this sales went down. So you would have different types of issues, probably bigger issues. Or if you were selling software in a traditional license model, and
That's good to know. So you mentioned about that traditional software versus subscription model, and what comes to my mind is the transformation from Adobe and how they became a really big subscription powerhouse, and their valuation just went up the roof. So that's pretty interesting to me.
I have a follow-up question for you, Christoph. Obviously, interest rates are quite high right now. Do you see a world where SaaS companies can grow 100%, or where SaaS, growth in our industry is high while interest rates are above, 3-4%?
That's a really good question. I think I would say for some companies, yes, but there are always outliers, right? The question is if that helps the average or most SaaS companies. I don't know, maybe Sid, you can speak about this with more data that you've collected. Also, I think in the latest presentation, you also have some data from the best of the best companies, and even they had a slowdown in growth. So I think there is some correlation, negative or inverse correlation between interest and growth. I think to a certain extent, technology companies can decouple themselves from macro stuff, but not completely, right? And that's what we're we're seeing. I think maybe if like the economy recovers, but there are still interest rates, I think maybe companies will be able to grow again, and maybe also quite fast. What I think is not going to come back with higher interest rates is like 50 times or 100 times ARR valuations. So I'm maybe less decided on, or maybe more optimistic about the growth opportunities, but I think the impact of interest on valuations is very direct, like just with a delay, but it's a very strong correlation. But super happy to hear everybody's thoughts on that.
I think that, Christoph, to your point, the outliers will always exist, but it's almost more important to me when we look at our data on valuations. It's almost about the rate of change rather than the actual number in terms of the interest rate. The interest rate can be 2, it can be 5, it can be many different things, but the pace of change over the past year has just, the whiplash from that has kind of rippled through the whole of the venture ecosystem. So if, Powell and others and the central bankers kind of slow the rate of change or even hold steady, and we kind of thought perhaps after SVB and First Republic and some of the banking problems here in the States, that would have been the case, but they continued to raise it a little bit. That would just provide a little bit more certainty, and then businesses could maybe invest at a higher clip. But as you said before, when you're selling to other venture-backed companies and those venture-backed companies are themselves wondering if they are completely overvalued, that cycle kind of feeds on itself.
Yeah, I don't have the answer, which is why I asked the question. But from my perspective, we raised the seed round at the end of 2021, and it was a $7.5 million seed round. Probably if we did that today, that would be like a $3 million seed round.
Yeah.
And that means, and it's not just from the dilution, all of that, but just, this is the money I have. Yep. And from the money I have to pay salaries, I invest in marketing, I do all those things. And if everyone collectively has less money to play with, right? I mean, leads, they don't come from thin air. But on the other hand, I think that the last couple of, and here, like every time when I speak with sales leaders, the first thing that people say is like, oh, it's so competitive for us. We have to win against competition. And like, why is it competitive? Because capital was cheap, and for every problem we're solving, there's 10 different people having a go at it, right? So it doesn't matter if your product is really good, you're competing against so many more people. So I'm very curious to see how it plays out, right? Because there is a scenario where there needs to be maybe like 3-5 years have to pass, a lot of people have to fail, and then again, that $3 million seed round takes you further.
Yeah. And then maybe in what we haven't talked about yet is that there is like, but what I'm sure is on everybody's mind is just the impact of AI, given the crazy advancements in the last years and even months, or like almost days, right? Like I think so. There is this macro trend which doesn't look that great, and then there is this other thing in the tech world which has so much potential, and which and Daria, you mentioned your product uses AI, so I don't know if it's something you want to share with a broader audience. If so, I would definitely be curious. But I think this has the potential to deliver so much value that it, I think, will allow some companies to grow super fast in spite of all these macro headwinds. Because if the value proposition is that we make your 5-person sales team as effective as normally a 50-person sales people, there's always budget for that.
Yeah. There are pockets, like, as you mentioned, Christoph, of fast-growing areas as AI. And Daria, like you mentioned that you talk to like sales leader and a lot of companies day in and day out. Like from like just talking to them, are there any pockets where like by industry or by vertical, like are there any interesting trends that you see that are there SaaS companies that are less impacted versus more impacted?
Yeah, so this is going to be an answer that's completely opposite to what we're just discussing with AI. But from the Salesroom customer base, we have a customer. It's a PE funded 400-person business in the US that sells software and services to the funeral sector. And they're doing phenomenally well. Because for them, right, if you're a funeral director, people are dying today just like they were dying 2 years ago, like they were dying 10 years ago. So I think the people who are most impacted are definitely if you're selling to other VC-funded businesses and they're not having such a great time, they're cutting costs. But on the other hand, I think vertical SaaS is probably not doing that badly, and vertical SaaS selling into industries that are quite resilient. So healthcare, utilities, other things that are more recession-proof. That being said, I think in every customer base, if you run the numbers, hopefully with the help of a platform like ChartMogul and Beth's ChartMogul, and you segment your data based on, okay, who are the customers who are staying and selling, and look closer into this, I'm sure that in every customer base, like if you're still in business, there are still people who need what you do. And if you dive like really deep into the numbers, there's a lot of stuff to uncover there to find pockets of value for everyone, not just people selling to funeral houses.
I think on the point about, relative scale of different industries being differently impacted by this macro environment, to Christoph's earlier point about AI, the infusion that we've seen, especially for early stage SaaS companies, of AI into both the pitching and the actual business models of these companies has been pretty rapid over the last 6 months. So I'll speak from a little bit of a more US perspective, but a lot of our companies are based in Silicon Valley and New York. Within those cohorts, the median valuation for a SaaS company on a seed stage is probably something like 13 million right now. But the median seed stage valuation for a SaaS company that is AI forward is about 16 million. So that gap is pretty wide. And then again, if you did that same analysis at Series A, you go from something like 36 or 37 million as a median for SaaS up to 50 million as a pre-money valuation median if you utilize AI. Now, I'm not making a value judgment here. When we did the analysis, if they said they used AI very prominently, we took them at their word. You can have a lot of debates as to whether or not someone just using OpenAI credits is really an AI company per se. But it does seem to be one place where investors are more willing to go higher on valuations, go higher on cash raised amounts, and have a little bit more optimism. But it's not the only place. We see a little bit of that in climate tech as well. And we see a little bit of that in some non-SaaS industries that are kind of more hard science. So it's not as though everyone is being equally impacted by the downturn that we've seen over the last year and a half.
Also on the point of AI, and I'm not an expert on it by any means, but AI, like true AI businesses, are not very high gross margin, right? Because there's a high computing cost, and it's interesting how it plays out, where at the early stage, we value that so highly, but when push comes to shove and you're like, okay, show me the numbers on the paper, I think probably that excitement comes from this idea of winner takes all, which I personally don't think will be the case. But
it's interesting to see, Christoph, I'd actually love your opinion as an investor in this space currently, like what constitutes an AI company? Do you have to be building the models yourselves, or is it that you have a better UI and a workflow advantage and you can inject ML into the things that you're doing? Like, how do you think about valuing these companies based on, the marketing or the tagline, or do you have to get deeper than that?
Yeah, I tend to think that it's a very temporary thing to call companies AI companies or not AI companies, because in the not too distant future, every software company will use AI to make their product better and smarter. And I think maybe the obvious or famous analogy is that like when mobile started to become a bigger thing or got mainstream adoption, then companies called themselves like we're a mobile company. And usually, I mean, there are some of these still, like maybe for mobile consumer apps, for example. But almost every B2B SaaS company has a mobile app now, right? It's just one way to access the product. And I think there will be a use for AI for almost every B2B SaaS app. I think it's hard to, if you have some imagination, to not come up with ways how the product can become smarter using all kinds of things. And because of that, I think this distinction, I think, will eventually go away.
Yep. Well said.
That doesn't mean that companies don't have like vastly different amounts of investment in and expertise in this, and maybe have a very different way of doing it and then creating value. Like for some, it's only going to be a building block. They just use some open AI APIs or other APIs, just like they use like a database or some other component today. And in that case, it's probably not a differentiator or nothing that really adds to the defensibility, but it's still something that creates value for the customer. And in other cases, it might be a source of defensibility if it's something very unique.
Another trend that we are seeing in the data is around, generally, like what we have noticed is that it's become harder to acquire new logos in this current market. And what companies are trying to do is they are trying to upsell and retain their customers. So that's kind of like upselling and retention has become more important in this market. Like, and that like, and not just as a like retention strategy, but as a growth strategy. Like Christoph, you or Daria, you like, are you also noticing that in your companies or like the portfolio of companies that you look at? And are there any strategies that you'd recommend our like audience take away from this?
Yeah, I'd be curious because you have a much bigger data set than what I'm looking at across the portfolio is maybe compared to the ChartMogul or Carta data set. It is more anecdotal. Like, did you see that companies were actually more successful in adding expansion ARR than they were in previous years, or is it only a bigger proportion of growth because the new business ARR has declined in comparison to previous years?
It's the latter. So definitely both new business and expansion is lower in gross terms, but the mix of proportion has changed.
Makes sense.
New logo is lot less and expansion is a lot more. So it used to be around like 60-70% new business, and now it's around like 50-60%. So it's come down by around 5 to 10%, and it's like has grown from like 20-30% to 30-40% now.
And I guess what's maybe behind that is just the behavior of companies that in a time like this where they freeze budgets or try to cut costs, the first thing is they don't buy anything new, right? And then only after that, maybe they see like which from our existing spend can we cut. And because of that, and I mean, it's generally always, I think a saying in marketing, like it's easier to keep a customer or retain it. I don't know how many X times more expensive to get a new customer than to keep an existing one. And that's probably even more true during times like this.
So something that I see a lot is people used to treat renewals as in just like press a button, send the order form, collect cash. And now you almost have to treat renewal as a rediscovery. You have to see that conversation. You have to go back to the drawing board and be like, what are you still trying to accomplish? What have you accomplished? What are your goals this year? And a lot of sales teams are not set up that way because for a lot of customer success managers, it's a slightly different skill set. So that's become a very big topic. I know a lot of sales leaders who are trying to make their CSMs a little bit more like AEs, have their AEs step back in, stay on the account for longer. The other trend that I'm seeing also about sort of like pockets of value, not the way budget is taken away is not equally distributed. So unfortunately, I think marketing teams and people teams are more hard hit than other parts of the business. And I've seen a lot of products trying to like who previously sold, for example, into the recruiting team, now trying to sell into engineering team. Those who previously sold to marketing, trying to sell to sales. And my advice, if you are in a similar position, and it's something that I think is like the best kept secret of sales, is multi-threading. I wish one day someone, maybe once ChartMogul CRM becomes big and you have this other set of data to see churn versus how many contacts you have on the account. And I think there's a very strong negative correlation, right? Because the more people you know, the more advocates you have, the more problems you can uncover. And even if your biggest champion leaves, you're not, and I think that's another cause of churn, right? When your champion leaves, you're an orphan. And there's nothing worse than being an orphan product in the organization, because that's the easy cut. And so I think my advice, and from what I'm seeing from people who are doing this right, is try to make sure to have at least 3 people, like 3 champions, ideally from different departments, so you see different perspective, and keep that relationship going after you sell.
Daria, to that point, we just did an exercise at Carta where we reviewed all of our SaaS spend. And first, I think it was kind of shocking that we had, Carta's about close to 2,000 employees now, and we had nearly a SaaS per employee, basically. So the software was a little bit out of hand, but to your point about champions, the first cut was about when people didn't speak up. If you were in that meeting and no one spoke up for that tool, it was the easiest possible thing. So I love the idea of kind of building champions across the business. But to that point, is it like, do companies risk wasting time to say, all right, I've been selling into the sales organization, I know that's harder now, I'm going to start selling into HR, but how do I need to pivot my product? Like, it feels like it could get really tricky really fast.
I mean, I think if you're a salesperson and you don't want to speak to customers, you're in the wrong fucking job. I'm sorry. And data show that salespeople spend like 30% of their time with customers and 70% doing God knows what, LinkedIn posts. I don't know. So for me, like it's one in the product, and maybe once you sell, or let's say you're selling a recruiting platform that touches all functions, and at the late stage of the process, I would be like, hey, I really want to make sure that you are successful, and in my experience, in order to make you successful, the people around you need to be on board. So do you mind introducing me to the hiring manager from engineering? And then once they make the intro, I get on the call and I say, hey, I'm so happy I'm talking to you. I know the perspective of your colleague from recruiting. Can you tell me a little bit more? And I think if you develop that muscle of speaking to different people, and it's just a matter of, send more emails, book more calls, talk to more people. And then when the time comes and you have to do the hard pivot, at least it's not the first time you're trying to sell to an engineering manager.
The next big thing that I want to discuss with all of you is around growth versus efficiency. So like we had this, like 2020, 2021 was all about growth, doubling, tripling, as we discussed earlier. And now it's kind of like the needle has tilted a little bit towards efficiency. And what I see is like a focus on rule of 40 for even earlier stage startups. So like startups that are like $1 million ARR. Just putting it out there, like for anyone to pick up on this, is that the correct approach? Like should that, like, for example, Daria, where you are at in terms of your revenue, like should efficiency be that big a focus, or like whether growth clearly trumps growth should be the clear focus then? That's
I can start. I think from my perspective and where I'm sitting, growth, I think it depends, right? I like to think of like unit level economics versus overall, how much are you investing in product? There was another report that came out yesterday by Insight Partners looking at like self-reported sales metrics, and they found that the highest growing companies in the 1 to 10 million ARR range spend 83% of their money in sales and marketing. And even I wish they come and all buy Salesroom, but that's crazy. That's so much money that goes towards. So I think growth is still important, because at the end of the day, right, if you have raised venture capital, you have to keep growing. You can't run your business as if you didn't have investors and hope to take dividends. People will have to get their money out somehow. That being said, should you pedal on gas and risk dying versus grow a little bit slower for a few more years and then accelerate? Probably the latter is more interesting. But for me personally, before I invest into any initiative, I want to see results from it, and I'm never going to put money into something where I don't know what's going to come out on the other side.
Got it.
Yeah, and happy to maybe talk about this next. I mean, I think as you said, Sid, like until 2021, like it was all about growth, like growth at almost any cost. That was like the message as you as a founder received from many or most investors and in the market, and that has clearly changed. So I think the question is really where is the right balance? And I think there is no general answer to that. It really depends. Like it depends on how much cash you have in the bank and how confident you are in your product market fit and what the competitive situation looks like. So I think there can be very different answers for different situations. But all other things being equal, yes, like it has shifted somewhat from growth or quite significantly towards sustainable, profitable growth. I would say a lot of the things that everybody agrees with now probably would have been mostly true 2 or 3 years ago already. Like, don't invest in a big sales team before you've made it work with a small sales team, or don't scale an engine that doesn't work. So I think a lot of things actually should be true at any time, but when money was so easily available, it was kind of ignored. And I think it's probably not any particular person or groups or stakeholders' fault. It's just the and like the strange thing, what happens when a lot of people act rationally individually, but collectively it looks like mass panic. So yeah, I think now it's in this new environment, it's about finding the right balance given all the specific parameters. The investors, it still takes growth to get investors excited, right? Because as a venture capital investor, you're still looking at building a portfolio of companies, and the expectation is that some of them will become very big and then generate a great return and offset some of the losses that you inevitably have. So you still need to hope to find companies that can grow very, very fast. And because of that, I think if you want to fundraise, you still need to have like some growth, right? We can debate what's good enough, depends on the stage of our scale that you have, but it's still what gets them excited. And then maybe in the next step, you need to show that you don't buy this cost at this growth at crazy costs.
Got it.
I have a very mean question for Peter.
Go ahead. It's not from me.
Good. Yeah.
Well,
Looking forward to it.
as far as I know, you guys are also doing secondary transactions, right? Or through the Carta platform. And I think if we reflect on the craziness of the last few years, and we look at like an early stage investor, like not an institutional one like Christoph, but some smaller funds, and they were like, okay, if I invest now at this crazy number, and then I sell in a secondary into like a Series B, I'm good. I made my money, right? And I think that stance kind of drove a lot of the behavior, because a lot of people weren't even thinking if the company can be fundamentally profitable. Like, I mean, we can think, and it's probably less so in SaaS, but if you think of the scooters, food delivery, and like all of that group, right? So how do you think? Do you think like secondaries need to stop that mindset, or like what do you see in that dynamic, so that everybody thinks a little bit more rationally?
So it's a fantastic, mean question. Well done. The way that we've seen secondary liquidity happen, first and foremost, the vast majority of it was still happening in Series D and later. So it wasn't like a ton of Series A, Series B businesses were taking that much equity off the table. Secondly, and the way that we've thought about it internally at Carta is we enable two kinds of liquidity. The first is company-sponsored transactions, tender offers, and the like. So that's the founders and board getting together and saying, hey, we'd actually like to enable some of our early investors, but more likely our early employees, to take some of that money off the table as well, to get some liquidity for the money or the value that they've already provided. That is something that I think is pretty great. I don't think it's reasonable oftentimes to expect an employee to say, I'm going to sign up, I'm going to take equity from this company, and the only way that I'm going to get anything out of it is 12 years down the line, there's an IPO.
Yeah,
I think there's a lot of room for employee value that can be created along the pathway to it. Now, did some early investors use the strategy of invest at seed, cash out at Series B? Definitely. It was 100% happening. Not as perhaps as big as some people might say. I think the actual biggest thing that's happened in terms of the venture mix, however, is not that the people that were investing at seed are gone. It's that the crossover funds, Tiger, SoftBank, et cetera, have just receded from the market almost entirely. So the later stage you are, the more difficult fundraising happens to be at the moment. There's actually still quite a lot of capital in seed and pre-seed and that sort of early stage rounds. Investors are being far more picky about the companies that they choose to invest in, but the funds are probably there. And the question is, when will this sort of thing be re-released into the market? Because if you're a founder that needs money in the next 6 months, the fact that a seed fund can invest that money over the next 2 to 4 years doesn't really help you, right? Your timelines are completely misaligned. So I think that secondary liquidity is here to stay, but it's perhaps there's some idea about lockups and things like that, so you don't get the sort of boost for a little while and then cash out. That's not a behavior that we love, although we did see it happen.
Peter, you mentioned about like funding still being there in the seed and not being there in the late stages.
Yep.
And we have a question from the audience, like, are there any like growth or like funding trends around like US versus non-US markets? So like Europe or Asia, and like how are like growth rates of funding there compared to some of the other markets like US? Is it better out there?
Yeah, so I don't want to speak as a definitive point of view here. We are still building our European data sets. Actually, we acquired perhaps like Carta in Europe called CapDesk. So hopefully we have far more information on valuations and fundraising in Europe in the months to come. I will say, as we start to look at this broader perspective, what seems to have happened in a lot of our data is that investors have retreated to what they know. So if an investor was a Silicon Valley investor who in 2020 and 2021 made more investments in Asia, made more investments in other parts of the States that they weren't very familiar with, in 2022 and 2023, they've kind of shifted their focus back to the Valley. And it's just true that more mature ecosystems have held up relatively better. But when you look across geos, I think it's actually less, the difference is less stark than when you look across stages. So again, this analysis is pretty fresh, but seed stage valuations have dropped 10 or 11% as a median from 2021 Q1 2022 to Q1 2023. The median Series D valuation is down 65%. So it's just a crash that comes in waves throughout the venture ecosystem, and seed, because you should be quite far away from eventual exit or IPO. If you don't know what interest rates will be like then, we don't know what the macro environment will be when you're ready to IPO. There has been relatively more optimism. I know that doesn't help the founders on the call right now who are saying, yes, it's very difficult to fundraise and seed. I don't believe your metrics, but just know that if you were a Series D founder, it might be even more stressful.
Got it. There is one more question that we've got from the audience, and I want to make sure that we address it. Have customers become more demanding? So everyone is seeing the squeeze. Are they demanding more from the platforms? And maybe Daria, you can take this first.
I think smart customers have gotten better at negotiating. That's because everybody knows that everyone is keen to acquire. It hasn't happened to us yet, but I know people who had to drop their prices at renewal to less than half. I personally would never do that because I think it destroys some brand and some value that you have to spend ages and ages building back up, because word goes on the street very quickly and how much you can renew certain products. I think customers are demanding in that, like, if you put yourself in the shoes of your customer, which you should always do, right? No one buys software because it's fun. People buy software because there is an underlying transformation or there's a problem, and there was a comment about outcomes in the chat from Anka, like people want to buy a certain outcome. And in times like this, if you put yourself on the line for something and it backfires, like, you can get fired over this, right? So the risk for your buyer is so much higher than it was before. And so the scrutiny that their company will take on them and the scrutiny that they will take on you is just on the ROI, right? If there's a question that their CFO asks them that they can't answer, it looks really badly on them. So I think it's actually for me, it's a very, very good sign when the prospect is asking very detailed questions, because that means that they're really keen to go ahead with the process and they're trying to eliminate that risk.
Got it. Some of the data that I have been seeing as well, like, shows that sales cycles have been lengthening. So they used to be 15 to 30 days on average. Now they are closer to like 45 days. So that kind of correlates well to what.
Yeah, absolutely. Because now it's not just enough that I want to buy something. My counterpart in marketing has to agree, and someone else, and so the number of meeting adds up, and people. And also, I think sales cycles, it's an average, right? And I think it's some people still buy fast, buy slowly. I generally kind of tell people not to focus too much on this, because a closed one deal is still a closed one deal, right? Make sure you just have a big pipe, enough meetings, and then even if something takes longer, just make sure you're covered and hit your numbers.
To end it more on a positive note, probably one insight from all of you here. What data point or like what signs are you looking for a turnaround? So like we have like in data that we have at ChartMogul, we are seeing new business like getting warmed up again and picking up again. Are you seeing like what signs would you be on a lookout for a turnaround? Peter, go ahead.
Oh boy. Couple signs of returns to normalcy or a turnaround that we'd be looking at. One is just time to fundraise. I think that metric has been getting progressively lengthened, and it kind of topped out this past quarter. So perhaps if it starts going back down on a median basis, I think that's fantastic. And then this is maybe not as useful as like a indicator or a prediction mechanism, but I do think that venture eventually needs the IPO market to reopen just to unlock the rest of the stack. So when you see that happen, I would breathe a sigh of relief. I know that there's talk of Klaviyo and others maybe opening that up in the near future, but I hope that becomes true, because I think that will be a good sign for what's coming the rest of the year.
For you, Daria?
So I'm obviously very close to the sales and marketing folks. I think for me, it's quota attainment. So Pavilion publishes a quarterly report where they survey people. So you can go on the rep view and see how many people are grossly unhappy about their compensation And I think that once people start hitting quotas, that means, that everyone's ready to grow again.
And for you, Christoph?
Yeah. I mean, I think on the one hand, there are really like some general indicators like the stock market and like general industry data that could serve as like leading indicators of an upward movement. But I think if I put myself into the shoes of a SaaS founder or people in a SaaS company who might be listening in, I think it's probably more relevant like for them to look at really what's happening in their business and what's happening in terms of like the velocity of leads, sales cycles, customer conversations. So I think everything that's happening around you, maybe that's still like interesting and maybe to some extent informative, but I think ultimately you'll see it in your own numbers and maybe in the quantity and quality of the conversations with customers or prospects, or you'll see it, as Daria mentioned, in like the quota attainment of your salespeople. I think unless that happens, then you can't really bet on it, right?
But we are at time, and I really had a blast like speaking with all of you and like getting to get your opinions on the recent growth trends. Thank you so much to all of you for joining. Chat next time.
Thank you.
Thank you.
Thank you. Bye-bye.